MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim, and a good Friday morning to you.
Is this bounce in the market the real deal, or is it tricking us?
Hey, that's a good one. We should look at, it ran into heavy liquidation, which means there are many accounts who suddenly discover themselves offside. And when you're leveraged, you've got to either come up with more margin or get sold out. And this I'm always like, because everybody, and especially Wall Street, really think the central bank is something else again. And the Federal Reserve is brilliant and has immense power, but they're very good at helping out and easing money during a boom. And then prices get overdone. We call it speculative exhaustion, and then prices come down. And the late buyers using leverage, that you then have to face Mr. Margin at your brokerage account or the equivalent in corporate lending and banks and trust companies and stuff. So anyways, then there's a massive shift in power, supposedly at the central bank forever, but the power shifts over to Mr. Margin. And he has immense power. And this is why stock markets go down so fast after a speculative binge. So this is what we had, and it came right down till, December 24th, the day before Christmas, when stocks and crude oil, junk, bonds, base metals, things like that were really beat up and technically oversold. So, hey, the call was for a bounce, and the bounce came in and right up to early in the week, where we started to see technical excesses being registered for those same market items. And now it's starting to roll over. So in any hard-pressed market, you're going to get bounces from time to time. And on this one, I think the decline will be a big test of the previous low. You'll recall back in August we were talking about the probability of a dismal price for crude oil sometime in December, January. And we've looked at the charts, and that seasonal low can mainly occur in January, and January's not over. So when the overboughts came in early in the week, it made me think, maybe we can get another decline in crude oil, which would then probably complete seasonal weakness. So anyways, once we get through past these travails, we could look for firming markets in the first quarter. But it should be understood that these would be probably tradable rebounds within a long post-bubble contraction. If you really research all of the previous great financial bubbles, of which the first one was the South Sea bubble in 1720. They're the greatest thing of a generation. And people get amazingly committed to them. Yeah, because they're making everybody so much money. And this is then when, why own 100 shares of something with the margin, 200 and make twice as much on the way up? And that's what everybody gets committed to leverage. So, and it's not just in the stock market, although the stock market gets most of the headlines, but the same risk-taking is done in credit markets with the yield curve, where you can borrow short and lend long, and then with the credit spreads, where investors are reaching for the highest yield, and the higher and you're also taking on risk, and then it sort of comes together. So what we were looking for through the summer was, you remember early in the year we talked about our friends of the bull market, which would be credit spreads, the yield curve, and industrial commodities. And all of those would be sunshine into around mid-year. And we did have that. And the other part of that we laid down, actually this was laid down in February, was that following the sunshine, August would turn likely to twilight, which it did. And then after August, September, then into what was likely to be the Twilight Zone, which was that scary TV series back in the 50s and 60s. So, and indeed, this is the hit to the markets has been an item from the Twilight Zone. But we think it's close to ending this leg of it, and there would be a bounce.
We'll have more with Bob Hoye right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the Pink, symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, I was just watching an interview on business television, and one of the people they were talking to said they're 75% cash right now, and the 25% they have in stocks is losing money. Is that the position most people are in?
Well,
or a lot?
That fund manager, if it was a fund manager, my gosh, they ended up in a good position. There's very few people, fund managers can move to that much liquidity. That's what we're doing during the summer, saying people should build liquidity, because in the fall liquidity would disappear. He's in a good position, but traders, of course, would be on the short side of a move like that. But we kind of like to write for investors, whether they're fund managers or looking after their own accounts, in a prudent way. And yeah, when you're talking about building liquidity and you're in the greatest bubble in history, you want to have as much liquidity as possible. But with fund managers, they have constraints whereby if they're equity fund manager, they got to stay at equities. And so what they do is we'll move to defensive stocks, whatever they are. And ironically, they own defensive stocks because they go down slower in a bear market. that's an irony. But at any rate, I admit that it's difficult for investors to go to 100% cash at the top of a bull market. But the way we look at it here is that in a bull market, of course, as cash becomes available, one buys the dips. And we have our technical model for that one, which gives what we call a springboard buy on those corrections that provide the opportunity to buy the dip. So then with a little bit of fine-tuning, we took that same model and set it up so that it works in a declining market, whereby one would then sell the rallies, in which case we call it a bearish springboard move, such as it came into our signals came in on Monday for bearish springboards on stocks, junk bonds, crude oil, stuff like that. So where one helps to maintain one's sanity in violent markets is to one have a historical model that will provide you with the path from a highly speculative market to the demise of such a market, and then have that backed up with the technical tools that say, hey, this is measurably speculative on the upside, in which case you sell, or measurably speculative on the downside, which was just going into Christmas. So it's fascinating, Jim, markets, when you look at it and know that the history of previous great bubbles and their setups are similar, and then the final rush up of excitement are similar, and then the rollover is similar, and then all of the great financial bubbles in history, and there's now a record of 300 years of them, is that they suffered in the crash in the fall. So this hit to the market recently is not unusual. Although, Jim, I'm going to say there is one thing that seems to be missing, and we've talked about this and written about it over the last few weeks, is that the changes in the credit markets and spreads in the curve have been serious enough that it might have pushed off some insolvencies or outright defaults. There's been enough of a change, but so far there's been no announcements of that, which has been interesting because you've had serious pressure in stock prices, for example, but no announcements of insolvencies at high places. So that sort of removes some of the drama. You've had the pain of the price drop, but no drama of failure. So maybe sometime next year, markets trade up and down, and we'll get through a little setback in here, and then, as I said, we're looking for better times briefly in the first quarter, but then you still have a problem with a huge bubble in debt that has to be serviced. And I read one a few weeks ago about the growth in the amount of triple B rated corporate bonds.
And Bob, maybe we can talk about that right after the break.
For sure.
Okay. We'll be back with Bob Hoye right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF, please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, what do you expect to happen with interest rates and bonds?
Yeah, as I was saying, the issuance of corporate bonds, a triple B rating, which is one notch within investment grade. So certain kinds of funds can buy those. And it's one notch above uninvestment grade or junk. So, and I can't remember the numbers, but it's billions and billions of this stuff has been floated. And in a boom, everybody keeps it together, and then when it slows down, these companies will find it difficult to service the debt that is barely investment grade. So what happens is that the credit rating agencies will downgrade them. So you go from triple B to junk. Then there are many fund managers who, by their rules, can't own the stuff. So it's going to come out, and as the saying is, who's going to be the buyer? Then the other one is that there were already huge amounts of already graded junk floated, and then there will be even the probability of, say, an A-rated security being downgraded to eventually junk status. And we've seen it in other contractions where sometimes the markets are changing fast enough that the credit rating agencies can't really keep up with it. So you can see triple notch downgrades from well above investment grade to investment grades, and then boom, down to junk. All done in one report from a credit rating agency. This isn't happening now, but after a great boom and a mania, that usually happens. So maybe after mid-year, there could be some of that sort of excitement ahead of us. Excuse me. The other one is the industrial commodities, which have been bid up and are heading down. And you want to take a look at what's going on in China, where a couple of months ago there was a headline that they had a vacancy rate for apartment rentals of something like 20%. And that worked out to 50 million apartment units empty. So, and then also this week China announced that they would not be as generous in supporting solar energy type of things. So maybe there's a little common sense coming in there. So what one sees here is a change from intense speculation to the first hit that takes out unsupported positions, and then we'll have a bounce in the first quarter, and then you got to look at the next time when there's a seasonal change to adversity in credit markets, and that would probably come after mid-year. And these excessive, big, huge bubbles are never sort of deflated gently or even held at a plateau. That's what one of the great economists in the 1920s, Irving Fisher, he had looked at all the rallies during the 1920s where it would go up, get overbought, then pause, and he called it a plateau, and then it would build another one. So in September 1929, his thesis was, okay, correct for a bit, build a plateau, and then away it goes again. and he was also personally long. He was owning stocks on his own theory, and he not only lost credibility, but he lost a lot of money too. So that was also the thing with Keynes in 1929. He was long the stock market and took a painful hit. So even big names can get offside in infatuating markets. So but the main thing, Jim, that I'm trying to point out is that you can never hold a huge speculative market and hope that just by going sideways for a couple of quarters will ease all of the speculative positions. They just come down, let's call it a stair-step fashion. And as bleak as it is, one might just well take advantage of it. And as we've got the path, and we have the technical tools that will make money, hopefully, as we progress along the path of a financial contraction.
Bob, thank you so much for chatting with us.
Well, we've had another week, and we're looking forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, we haven't heard from Belgium lately. You can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.